Indian markets are scaling fresh record highs and GDP growth continues to surprise on the upside. But the rupee seems to be telling a very different story. On Monday, Indian benchmark surged to new all-time highs before paring those gains on weak global cues. The Sensex reached a record intraday peak of 86,159, while the Nifty climbed to a lifetime high of about 26,326. That surge in stocks early on Monday was largely driven by domestic investors. However, the rupee continues to falter, trading near its record lows. The currency has fallen to repeated new all-time lows, despite the latest data showing the economy expanding at a faster than expected pace of 8.2%. In fact, weak trade flows, the absence of a US-India trade deal, and over $16 billion of foreign investor outflows have kept the rupee under pressure. India's trade deficit is at a record high, and reliance on imported crude, continues to push up the dollar demand. Sanctions on Russian oil giants have also indirectly weighed on the Indian currency. A deep dive into the over 3-decade journey of the rupee gives us a compelling narrative. By 1991, due to a severe balance of payments crisis, India undertook economic liberalization. That included a significant devaluation of the rupee to about 17.9 rupees per dollar. The correction back then reflected economic reforms like tariff reductions and encouragement of foreign investment. And over the 1990s and 2000s, the rupee depreciated gradually from 22 to 25 rupee levels in the early 1990s to about 44 to 47 rupees by 2000 and 45 to 46 rupees by 2010. And since then, the currency has fallen more significantly to about 90 per dollar last month. IMF expecting India to cross $4 trillion in 2026 and reach just under $5 trillion by 2028, almost $200 billion lower than earlier projections. And here's the key risk here. Economists are saying a calibrated depreciation is now inevitable, with the IMF projecting the rupee around 87 in 2026 and 87.7 in 2027. The fund does not see a crisis, but also warns of periodic pressure from global uncertainty, tight financial conditions, and trade shocks. India's long journey from 17 rupees a dollar in 1990 to nearly 90 today reflects higher inflation than the US, persistent trade deficits, and the heavy oil import bill. The country, which is the world's second largest consumer of crude imports, over 85% of its needs, and unless the currency stabilizes, a weaker rupee could delay India's ambition to become the world's third largest economy, even as growth and markets continue to outperform. To stay up to speed with the latest news, download the WION app and subscribe to our YouTube channel.